Welcome to Beth's Happy Home. I'm here today with Lexi Stevenson, who is my daughter-in-law, and she is a personal banker. She's going to give us some advice on building good credit and avoiding financial pitfalls. So Lexi, what do you have for us today?
So like Beth said, I've been in the banking industry for a little over 5 years. So these are just some tips and tricks that I've learned that I try to instill in all of my customers so they understand how to build credit and also what hurts your credit score. Number one, in order to build credit, you have to understand how to build credit, and that you also have to know what the different 3 credit bureaus are. So understanding that there are 3 different bureaus that people can report to. So first you have Equifax, number 2 you have Experian, and then you have TransUnion. Now something that a lot of people don't understand is that if, let's say, Chase or a credit union, they do not legally have to report to all 3 credit bureaus. If you have some line of credit with them, they can choose to report to 1, they can choose to report to 2, they can choose to report to 3. They're not legally obligated to report to all 3. So even though you may pull your credit score through Experian and you see you don't have a credit score, you may have a great credit score with Experian or TransUnion. Just depends on where your lines of credits are.
One of the others.
Correct.
I see.
So first thing you want to know is kind of where your goal is in terms of a credit score. People talk about what's a good credit score, what's a bad credit score. Your goal is to shoot for about a 740 credit score. That will entail, basically guarantees you best rate at any institution, whether you're going for like a mortgage, auto loan, home equity line of credit, any type of line of credit, you will get best rate. So in order to build credit, I would say the best way to do that is by getting a credit card. Now, my favorite story that I always like to tell people is my parents are petrified of debt. That is something that they or instilled in all of us children. Don't ever get a credit card, don't ever do an auto loan, never ever owe anyone money. And essentially that's not really possible with mortgage costs, that kind of thing right now. But one time me and my dad got into a huge fight. I think I was a senior in high school. I was 18, and to spite him, I went to the bank to deposit a check, and one of the bankers asked, "Do I want a credit card?" And I said, "Yep, give me one right now." So that's exactly what he did.
Lexi.
Yes, that is exactly what he did. He gave me a credit card. I got approved same day, got the credit card, everything. And then I went home and I said, "Dad, I got a credit card." He goes, "You did not." I said, "I did. I'm an adult now." And at that point, I wanted to enrage him, but not go overboard. So I didn't actually activate the credit card. I just stuck it in the back of my wallet. And then years later, I had never touched the credit card, never thought I activated it, nothing. Years later, I have a 740 credit score. And I didn't realize that some institutions, even if you don't activate the credit card, they'll activate it for you at a certain time. So at that point, I learned that even if you get a credit card and you don't touch it, you are still building credit.
That is very interesting.
Yes.
I didn't know that.
Yes. So a lot of people are petrified, like my little sister, petrified of debt because that's how we were raised again.
It's a good thing to be afraid of. Of
Yes.
all things that you could be afraid of, debt is a good one to be afraid of.
Correct. A lot of people get in over their heads and it can destroy lives, marriages, family relationships, everything. It gets really messy really fast. But what my sister did is she just did the same thing. She got a student credit card and she just hasn't touched it. And I told her, don't worry about it. Do not stress about it. At the time that you feel ready, that's when you're gonna take out that credit card and you're gonna start using it. So right now she hasn't activated it, she hasn't touched it yet, but I think it's a great start to where you're not ready to use the credit card, but you still wanna build credit. At a certain time, your credit score will plateau. So with mine plateaued at about a 730. So about a 730 after about 2 years of never touching my credit card, I felt like I was finally ready to be an adult and to start using my credit card. So then all of a sudden I saw my credit score start to go up because I was slowly using it. So that's kind of the little tip or trick if you're not ready. And then also another tip would be to use less than 30% utilization. Utilization is how much of the amount you're using off of your limit. So banks and institutions will decide based off of your credit score and your history and your income how much they think that you could borrow up until they think that you're not going to pay it back. So like for me, when I was a student, I wasn't making a ton of money. So I think my limit was about $1,000. I think they gave me a $1,000 limit. So at that point, I could spend up to $300 max before something was like, hey, you're using more than 30% and your credit score will start to slowly go down. Obviously, if your limit is $1,000 and you're using $1,000 and paying it off, $1,000 and paying it off, it's going to think that you're 100% utilization, which means that you don't know how to use and spend your money and that kind of thing. So that's the one part that I always tell people is keep it minimal. Even though you have a large limit, spend like you only have 30% of that limit. And then also another thing that I see at the bank is wives, girlfriends, significant others that are female don't feel like they need to get on a mortgage, which is insane to me because that is one of the ways how you build credit. And a lot of times it's because they'll keep the wife off because she never got a credit card, she'd never had a loan before, so she did not have a great credit score. And mortgages go based off of the lowest credit score.
Oh.
So females, I feel like they should start early by first getting a credit card and figuring out how to use the credit card so that they can be on the mortgage to continue building that credit. So that's the one thing that I see that a lot of women regret doing because they're like, oh, I do have a credit score. And I said, but you're not on the mortgage. So if you don't have any other lines of credit, you're not building your credit score.
Oh.
So
I can't imagine allowing, I mean, if my husband and I are joint, wanting to let him be the only person on the mortgage because that would make him the only person on the deed too.
Yes.
And if he died
Correct.
or, something happened, that would be a mess.
Correct. And it's not as messy if you're in a community property state where it's obviously if your spouse owns a house, then that's obviously partly yours. But in states where it's not community property, it just gets really messy. So it's so much simpler if you just put you and your other spouse on the mortgage together so that you continue building credit together.
It's interesting.
Yeah. Some ways that you can destroy credit, there are numerous ways of how you can destroy credit. And obviously, most people know that you can destroy credit within 30 days. Building credit, that takes years. So I always tell people, if you're gonna do anything to destroy your credit, realize that you have to now spend the next 5 years building up your credit score, which is so much work. So just figure out how to not destroy your credit score day one. So number one is settlements. This is what I deal with all the time. No one understands how settlements work. No one understands what a settlement is. And banks kind of want to keep it that way. Places that are lending to you money want to keep it this like mysterious thing. And it's for...
But you're going to tell us.
Yes.
Oh, I'm so excited.
So anytime you settle, that means, let's say, Beth, you owe Chase $1,000. But you haven't paid on that for 5 years. So at this point, Chase will take any money you give us because we haven't received any money for the last 5 years.
Yeah, so a little bit is better than nothing.
Correct.
And if I go along with that.
Yes, so Chase will say, it's okay, Beth, don't worry about the $1,000. Just give us $200. We'll call it even. You're totally fine. How good does that sound to you?
Yeah, well, if I were in that state, I'd take it.
Yes.
Heck yeah.
Heck yeah. That's a bargain. You just got 80% off. You kidding me? I'll take that in a heartbeat, which is exactly what the banks want you to do. Because at this point, they're already cutting you off as a loss. They're already thinking, we're never going to get the $1,000. So the fact that she's giving us $200, we'll take that and we'll just run with it.
Yeah.
But that shows up as a settlement on your credit score, which means, Beth, you take out loans and you do not pay them back. Which for future mortgage loan companies, anyone that's going to give you a line of credit in the future is going to say, why would we lend to Beth? She doesn't pay back in full.
We got $200 out of the $1,000 loan. Yeah.
Why would this is a stupid bet. Why would we ever give you a loan?
Yeah.
And so that's one thing that people are like, oh my goodness, I'd never even thought about that. So in essence, if you're never wanting to get a mortgage or an auto loan ever in your entire life, settle all you want. But if you ever want to get a credit card, you ever want to get an auto loan, you ever want to take out a home equity line of credit, if you ever want to do anything with your credit score in the future, I highly do not recommend settling with any institution. Get on a payment plan. Say, I'm so sorry, I can only pay $100 a month. Can you work with me?
Yeah.
Almost every single financial institution is going to say yes because they want to get paid.
Yeah, that's interesting.
Next thing is late pays. Most financial institutions or places that carry your loans will give you some type of grace period. Say, if your loan is due on the 22nd, you have until the 30th to pay before we start giving you fees. Now, essentially, it doesn't really hurt your credit score until you're 30 days late. At most institutions, you have to check with the financial institution that you're with, but most of the places won't ding your credit unless you're 30 days late. Other than that, I would just make sure that you're just never late, because cutting it close like that, I've seen horror stories happen. But yeah, definitely check with your financial institution just to make sure, hey, at what point are you going to ding my credit? At what point am I going to get charged late fees? Understand that your loan is very important to your financial institution and also for your credit score as moving forward.
I have a question. What about putting payments on auto payment? Is it safe, and does it affect your credit score?
I think it is safe. The part is there are glitches. Any type of auto pays, anything like that, anything that is behind a computer, there are going to be glitches. I've seen many times where it's been on auto pay, but something goes wrong in the system and now nothing pulled, and so your payment is late. And so for me, as a person where I would never want to like injure my credit score in any sense, I pay personally, and I go in every 2 weeks and I pay off my credit card every 2 weeks. That's just me as like an OCD person. I want to make sure, I never ever want my credit score to be dinged because of something that I just overlooked, or I relied on an automated system where I just thought that, oh yeah, that'll be totally fine. And in essence, that could totally screw you over.
Yeah.
So I say it is good, but at the same time, you need to make sure you go back into your bank account and say, did it pull on this date?
Yeah. So it's a good idea to have it as a safeguard, but check it.
Yes.
Okay, that's interesting.
Yes. The next one would be credit checks. There are two different types of credit checks. There's a soft pull and a hard pull. Soft pulls would most likely be like if you're gonna go get like a rental, like if you're gonna go get an apartment or something like that, they'll just do like a soft pull. Some places will do a hard pull, so you need to make sure that you know the difference when you're asking them when you're applying for an apartment. A soft pull would be like if you're a lot of like bank accounts, like if you're gonna open a bank account, a lot of times they'll do a soft pull. That is an inquiry. So that literally all it does is it's just a glance at your credit score, just to see how you're doing, get kind of a ballpark figure. It's not an exact amount of like where your credit score is.
Oh, okay.
Yeah, so it's an estimate. So a lot of people do that because it doesn't hurt your credit score. Hard pull would be like if you're gonna get an auto loan, a mortgage loan, if you're gonna get something where they need to 100% understand how you pay back, that kind of thing. That would be a hard credit pull, and that does ding your credit score. And a lot of people say, how much does that ding my credit score anytime you do a credit pull? I've seen it on average between 3 to 5 points every time you do a hard pull.
Okay.
So that's pretty average that I've seen. So make sure that if you're looking for a credit card, you're not literally applying for 20 different credit cards. You pick out maybe top two, and you apply for those two. Then if those two don't work out, then you apply to your next option. But don't just apply to 20 different credit cards and see, oh, I guess whoever wants me will take me.
Or 20 different sources of credit to buy anything or borrow any money. Okay, that's interesting, yeah.
Yep. The next one is going to be closing credit cards. A lot of people think, oh, if I'm not using it, I'll just close it. It's one less thing to think about. That is a wrong mindset. What you want to do is if you're not using the credit card, you keep it open. You pay it down to 0 and you keep it open. If you close that line of credit, you're going to injure your credit score and you're going to lose all that credit you just built up.
From that credit card? Oh, I didn't know that.
Yes, and a lot of people don't.
I'm always urging, you know, we've talked about, my husband and I have talked about having credit cards open and worried about fraud, that someone could get in there and use them for fraud. And
yeah, when in actuality, those companies are looking for fraud descriptions or transactions. So if they do see something going on and you haven't used a credit card for years, they'll notify you.
Oh, okay.
They'll say, hey, Beth, did you do this transaction? We've seen that you haven't used your credit card for this amount of time, and now all of a sudden you have all these transactions from another country. And so they'll notify you.
Oh, okay.
So it's not a huge deal, and I always tell people, just leave that credit card open. Don't touch it. Some institutions, well, if you haven't used it for like 5-7 years, they'll close it automatically. But essentially, if you're not using it anyways, that's fine.
Yeah.
But I always
you're
tell
not
people,
really building a lot of credit with them anyway.
Correct.
If you're 7 years out or
Correct.
something.
Yep. And I've seen people where if they're applying for a loan with me, I'll see like pages and pages on their credit report of 40 different open lines of credit, and they have an 800 credit score. Does not matter how many open lines of credit you have, because all those are zero balances. So it doesn't count against you in terms of how much debt you're carrying.
Interesting.
Yep.
Yeah, that's very interesting.
And then last but not least is knowing the difference between a joint credit card and an authorized user. Joint credit card would be if me and Beth wanted to get a credit card together. Some institutions are not doing those anymore. They're kind of sliding away from doing joint credit cards. They're wanting just to have one person solely responsible for the credit card and then having multiple authorized users. So the joint would be me and Beth going together. We are both responsible for that credit card. Whatever amount we put on it together, we both have to pay that at the end of the day. Authorized would be if I wanted a credit card and I wanted to add Beth to where she could take my credit card and go to the gas station or the grocery store and put money on that credit card, but at the end of the day, I am solely responsible for paying that debt off. Beth has nothing to do with those payments. She can just put money on the credit card.
All right, I'll take out an authorized user and you can pay for my debts.
Perfect. That works for me. So in the older days, I would say probably about 5 years ago, they changed it to where every parent was getting a credit card and putting all of their kids on the credit card as joint or authorized user.
Yeah.
And essentially what that would do would help the kid to, when he turned 18, have an impeccable credit score. Which in actuality, people look back and thought, that doesn't make any sense. How does he have a perfect credit score when he didn't have to, he wasn't legally obligated.
He never was the one that paid it. Yeah.
His parents were the ones who should deserve that credit score, not him. So they understood, well, maybe we should kind of sly away from having one person be the sole owner and every other kid be getting credit for doing nothing. So right now, it's almost impossible to find a credit card where you can have joints, but you can always have an authorized user. So
and it doesn't help the authorized user's credit score.
Not anymore.
Oh, okay.
Nope. So when I put an authorized user on there, it does not show up on their credit report. It doesn't do anything for their credit. It only allows them to be able to use the credit card for on behalf of me. If I didn't, if I wasn't going to go to the gas station and you were, I would just
I see.
let you use my credit card.
Okay.
But yeah.
All right. Do you have anything else? Like, what is the most common pitfall, financial pitfall that you see as a banker?
I would say it's super basic, but just spending more than what you have. I see so many people going to the negative with their bank account, and every time you go into the negative, you get charged $20 to $30 per transaction. And people think, oh, next month, with my next paycheck, I'll just pay that back. But in essence, you're just digging a deeper hole because you don't understand that you need to spend less than what you have. So a lot of times credit cards work well in that situation when you're living paycheck to paycheck. Put it all on the credit card. When you get paid, pay it off. Instead of using your debit card at the financial institutions and getting fees every single time you go into the negative.
Yeah, I guess a debit card would have the equivalent of very, very high fees. Correct. Because it would allow you to go negative without sending you a signal. All right, well, that's great. That's really good information, Lexi. Thank you. I learned a lot.
Good.
I hope you enjoyed it, and I hope you'll come back and subscribe with us so that you don't miss out on any of the fun stuff that we're doing here in Beth's Happy Home.